Hi, my name is Jeff Thurecht. I'm the Director of AAN Australian Advice Network. I'm joined by Pablo and Nick from Stewart Investors today. Thanks for coming along, guys. So I thought we'd make a start by asking you just to give us a bit of a background on Stewart Investors and your investment philosophy and how you go about managing money. Pablo?
Okay, sure, I can start with that one. So I think it's important when you think about Stewart Investors and our sustainable funds in particular to take the longer view of our history. So we started as a fund manager back in 1988, and so over the course of those decades, we've applied a consistent investment philosophy throughout that time, and the types of things that you'd expect to see from any of our strategies are really long-term view. So we're talking 10 years plus when we invest in a particular company. We're very bottom-up focused, meaning that we are much more interested in the individual companies and their prospects than thinking about how big it might be in a benchmark or an index. We're not really concerned with benchmarks at all when we're thinking about risk. We're actually much more focused on capital preservation and not losing our clients' money. The other things that are probably really worth pointing out in terms of the philosophy and the way that we think about investing is that we're very much concerned with the quality of companies. And so if you don't think about the benchmark as being the source of risk, and instead you're trying to deliver really good long-term positive returns from individual companies, they have to be high-quality companies. And we think about quality in three different areas. We think about the franchise quality, so is it a good business? Are they trusted? The brand, have they got pricing power? Those types of aspects. The quality of the management team, so are they honest and competent and humble in the way that they approach managing the business, and the quality of financials, which is really around for us because again we're focused on capital preservation. We want them to be operating in a relatively conservative way, not have a very indebted balance sheet, for example, not taking shortcuts with tax and other areas in their financials, so that gives us confidence that they'll be around for the long run. Okay. Just the last point on in terms of sustainability then came in around 2005. So if you think about that investment philosophy, in 2005 we launched our first dedicated sustainable strategy, and the thing that comes in over the top then is this idea that we're looking for companies that are high quality but that are also really well positioned for sustainable development. And I'm sure we'll get into what sustainable development means, but I think those two things of quality and sustainability are really, really important.
Fantastic. So just so I understand, so that means that you're an investment company first and foremost, then the sustainable overlay has come in the last 15 years, which is still a fairly long time considering it's an emerging industry and many more people talking about it. Is that fair to say?
Now, as we've evolved, I think we see the two things as being so deeply intertwined that you can't actually pull them apart anymore. I think back at the time before starting dedicated funds, we still thought about sustainability issues, but we just didn't have them really out there on the front cover of the way that we were thinking, and perhaps it led us to invest in some companies that have sustainability headwinds, or they might have particular challenges around sustainability issues that were still high quality, but that we probably wouldn't invest in today. And it's also led us to think about opportunities in a different way as well, because we're looking for companies that have that tailwind of whether it's in healthcare or in the transition of the energy system or the transportation system. Those types of things help give us new ideas and new ways of looking at companies. But these days, it's just completely intertwined.
Great. And so the business is headquartered in Edinburgh, is that right?
Yeah, so we're headquartered in Edinburgh. We have offices in London, Singapore and Sydney, and we currently manage around 24 billion Australian dollars, and it's across Asia Pacific, emerging markets, and what we call worldwide, which are completely unconstrained investment strategies. Mm-hmm. Our team is about 14, and we run pure sustainable investment funds, and that's the bulk of that AUM team.
So there's a number of investment managers coming out of Scotland. What do you think it is about Scotland as a fairly small place that makes it good for investment managers?
It is really interesting. Some say the Scots were the original emerging markets investors because they funded the US railroads. A lot of them did. And there's a slight lineage of our company which was previously called Stewart Ivory, back to a business called Scottish American Investment Trust. Okay. And that goes back to about 1873 of funding things like the US railroads, Andrew Carnegie as he expanded the industrialists in the US. Scotland does have a rich history of that actual investment expansion throughout the globe. Then I guess there's other theories that living in a place with really bad weather just makes you work hard. And, we look that way in our investments as well. We love that cold corridor in North America, for example, Wisconsin, Minnesota, Pennsylvania. Awful weather, fantastic businesses.
Yeah, right.
So there's all different reasons.
So Pablo, you touched on, we'd probably get to talk about the sustainable side of things, so maybe we can launch into that. Can you, I guess there's lots of different people would use a different definition or a different way of explaining what sustainable investing is. So your fund is called a sustainability fund. So can you talk us through what that means to you and how you would explain what sustainability means in that context, either of you?
Sure, we could share it a bit, I'm sure. So I think if you take a step back, the way that we would think about sustainability is that we have a global desire for people to be at high levels of human development, so education, employment, incomes, health, they're the types of things which we want for all people. And at the same time, we have one planet which we're all sharing, and we need to be able to use the resources that in a sustainable way. And currently, unfortunately, what's happened is that as countries have become more developed from the human development perspective, we've gone to unsustainable levels of resource consumption, where at the moment we use around 3 planets worth of resources every year in terms of what it can regenerate. And so when we're thinking about sustainability and thinking about that broad view, we're really looking for companies who are well positioned and are delivering solutions to some of those problems, both on the human development side, but also on the environmental footprint side. And often the best stories are really to go, rather than to sort of philosophize about it, is to think about individual companies and the things that they do. And one company that I particularly like to talk about is Unilever, which we've invested in, I think, since the start of the fund, right? So fundamentally to us, Unilever is a soap business. It's the biggest seller of soap in the world, and it's touched about 1 billion people in emerging markets, both in terms of its products, by providing affordable hygiene and sanitation products, but also through education programs around hand washing and other things. And post-COVID, we all recognise how important hand washing is today. And so from that aspect, even though Unilever is a consumer goods company, it's probably had the biggest health impact of any of the companies that we have in our portfolio, because just the reach that it's had into emerging markets through its soap products. So I think that's probably gives one example of how that broad thinking about sustainability turns into individual company examples.
Yeah, and many people might think sustainability, right, it's green energy, for example, and it's much more than that. It's about investing in companies that make medicines and medical devices cheaper for both the emerging markets and for the wealthy countries. It's investing in banks in places like India that can provide people with mortgages for the first time. You have this enormous country coming out of poverty where people are beginning to want to own assets for the first time. And you need a responsible and sensible facility for capital to do that. And then it's all the way through to some of the amazing eco-efficiency coming out of industry, coming out of technology, and then of course energy as well. So we're not just a renewable energy company, we're looking at all parts of the economy, but they are all about how do we make better human development outcomes with a lower footprint, and at the same time make good returns for shareholders, because we don't want that trade-off. We don't think that trade-off is there.
Yep.
We think that one of the key ways to make good returns in the long term is actually to understand this economic development paradigm and where our companies fit in that. And once you understand that, and the companies who do understand that, they open up quite amazing markets for themselves in the future.
Just when we talk about quality before and whether it comes first or sustainability, they're so overlapping, because a lot of the aspects of how a company can exhibit a quality in its franchise, or the way that the management team actually take the company forward, if they're not actually aware of those big drivers in the economy around sustainable development and environmental challenges that we face today, they're probably not going to steer their company in the right direction. And so those quality and sustainability aspects really are really tightly knitted together.
Right. So when you think about the types of businesses you invest in, are you focused on, I guess one of the other terms that gets bandied around a little bit is impact investing? So it sounds like you are focused on making an impact, but would you call it impact investing, or is that a focus of where you're taking the fund?
Yeah, people are coming up with different labels all the time. We so far have shied away a little bit from the impact investing label, and that's because there is still a spectrum of impact investing. There needs to be, from the start, a dedicated view on measurability of the impact you're making. We don't always, or we're not always able to do that as a public equity investor. You don't have insight into the inside of a company always and what change it makes. Secondly, there's a question of what's called additionality. And what this refers to is there additional capital being put into a project to then create new impact? The reality is, as an equity investor, we're giving capital to companies who are doing business that have a great outcome and a great sustainable result. But ultimately, if we sell that capital or we sell that share and get the capital back, we're swapping the equity. It's not so much the new capital that creates those new projects. It's more about owning part of the company that's going about its business. So we've shied away from that. We quite like the word sustainable. You'll also hear ESG a lot. And where we think about the ES&G, the environmental, social, governance side of companies, because it gives you insights about the operational quality of the company. But ultimately, there are some great companies on that ESG metric. So, you know, Coca-Cola's really, really water efficient with its operations and bottling plants. That's great at saving water. That's really important. Ultimately, what they're selling is sugary drinks, and that leads to issues around health. It leads to obesity eventually, and that's not what we're looking for. That is not what we think is sustainable. It might be ESG, but it's not sustainable.
Yeah. And just on one other thing on impact, where we do and can have a positive impact is in our relationship with companies. And so when we invest in a company, we don't just look at it as trading an instrument that we're in and out of. Because we take that long-term view that I mentioned earlier, we try to build relationships with company managements and hopefully provide them with a view from one of their long-term shareholders that we want them to operate in a way that is going to look after all of their stakeholders, whether it's having good relationships with their employees, treating their communities well, treating their customers well. They're all things which I think it's important for shareholders to be sending that message to companies, and also that they operate in the long term and not operate for the next quarter's earnings, because often when you wind up having negative impacts on people or on the planet, it comes from having a very short-term view and making trade-offs over a period where you say, I'm going to take the profit for next quarter over and above what might be in the long-term interests of another group of stakeholders. I think that's where we see our greatest impact, is in building really good long-term relationships with companies.
Great. Does that ever sort of go an extra level and become sort of like activist investors, or have you ever had to sort of have, stand-up arguments with people? Or?
We like to call ourselves active rather than activists. We do have, so our conversations with companies are respectful. They're coming from a place of perhaps asking questions more than having the answer. They're often based on a fairly long-term relationship. There are many companies we've been shareholders of for 10, 20 years, and many of them have continuous management or families behind them. So we get to know them in that business relationship. But the conversations also can be uncomfortable at times. We can be, again, respectfully challenging some decisions and actions and what's taking place. We can be trying to influence and ultimately nudge into a certain direction. And so often they can be a little uncomfortable as well. But as long as we're perhaps planting a seed of thought in the minds of the owners or the managements of those companies, and perhaps if there are other stakeholders that might ask similar questions, that can then contribute to the change. But we're not the type who are taking board positions or trying to spill a company, or we haven't even really got the capability and resources to put forward resolutions. Even though we're happy, we obviously vote actively and support many that have come in front of us around environmental or social issues. But activist is not really us.
So we've talked about long-term focus, so investing in companies 15, 20 years and looking at that, which I think is fantastic and resonates really well with a lot of our clients who'll be watching. If we just, I guess, narrow it down a little bit, and we've been in a very interesting environment globally over the last sort of 12 months, and this time last year it was all starting to happen. Your portfolio return has been fantastic in the last 12 months, I think somewhere around 10% and about 16% per annum over the last couple of years. How have you done that over the last 12 months, and what's changed, if anything, since the sort of pandemic kicked off 12 months ago?
Yeah, part of our philosophy is always thinking about risk as risk of losing our clients' money more than deviation from the benchmark. And so we do tend to be a little more conservative at times or defensive, and the performance profile over time has always shown that, where we do well in falling markets. And in very frothy, fast rising markets, we can quite often lag behind a little bit. We were concerned in the last quarter of 2019 with markets. We felt they were very overvalued. We were quite defensively positioned, and lo and behold, the economy stopping pandemic turns up.
Just figure out what do you mean by defensively positioned?
Sure. So we were in certainly the top 10 of the portfolio, if not most of the portfolio, had some large M&C consumer companies and healthcare companies that very much had diversified earnings streams globally. We're not reliant on commodity prices, not reliant on government support of any way, very much control of their own business and their recurring cash flows. So plenty of businesses, especially our tech businesses, have very high recurring cash flows. Secondly, on the balance sheet, we were very conservative. We do tend to like net cash businesses or lower levered businesses. And so the portfolio was very conservative from a balance sheet perspective as well. Cash was reasonably high, and by that I mean around about 7, 8, 9% at that time.
What's normal?
So normal, an ideal world is below 5%. Yep. I'm not sure we've been in a normal world for many years now. I mean, at the moment today it's 4%. Okay. That feels okay. It'd be great to be down lower a bit, but we've also spent a great deal of the last 6 or 7 years between 5 and 10. So we were quite defensively positioned. We had a couple of high quality telecommunications companies as well. And that obviously then held up quite well in February and March. We surprisingly for us held up quite well then in April, May, June as things picked up as well. And those sharp bounces, we often miss that type of thing because you often get a re-rating of some of the perhaps lower quality businesses. But during that period, we took the opportunity to sell out of some of our defensive positions. So we're in things like Elisa, which is a telecommunications business in Finland, which has a unique model of pricing on the quality of its service rather than the amount of gigabytes you use. And it's a really fantastic customer retention rate, the first nation to move to 5G off the back of this model, and just continually grows in a very sensible marketplace. Great defensive role, but we took the opportunity to get out of that. Many of our Japanese businesses also held up very well. We had a couple of small Japanese pharmaceutical businesses that were obviously selling just, again, recurring products into a fairly elderly market. That held up well in a very sensible currency. And so we moved those things into some other companies that are perhaps a bit more set for the next stage of the cycle of growing out of economic downturn. And so everything from Infineon Technologies, which is a German company that does the power management semiconductors inside an automobile, and is getting a huge kicker off the back of electric vehicles coming through. Through to tech businesses such as Fortinet, which is doing global internet security, just really guarding us against malware and similar attacks onto IT software. Coming off quite sharply gave us an opportunity to to really build a position into those companies. So we've moved out of some of the more defensive names and into more technology, some more quality healthcare names, and some more industrial. So we think a bit better position for a new phase of a cycle, whereas we felt things were quite toppy before COVID turned up.
And so what do you see? No one's got a crystal ball, but what do you sort of see the shape of that recovery or this next cycle? Because, I know I was a little bit nervous last year when things bounced back so quickly.
Yes.
What are you guys sort of positioning for?
And we were caught by surprise. We certainly did not think, we thought there'd be a second bottom almost in March or April. So we were very much surprised. We're not particularly good macro forecasters, but what we see is a world with a huge amount of debt. We see central banks and regulators or governments who are, manipulating asset values through their policies. And we see what appear to be some fairly high expectations around growth, the ability of growth to come through into our companies. So all of those together mean really many of the companies we like, these quality businesses who understand sustainability, are set up for great times ahead. The question is, do the great times come? And that requires regulators and central banks to get it right as they release the valve, pandemics and vaccines to go right, and then all sorts of other geopolitical risk that comes along. So, we've got all sorts of interesting semiconductor companies at the moment. It's a big topic between China and the US. China could very easily gain supremacy on technology, which it hasn't had to date, by taking a small island off its coast, which would lead to all sorts of global problems. And so there's so much uncertainty. We're just sticking to that quality thesis. Companies in control of their businesses, good recurring earnings, sensible people with integrity who run these businesses, and generally no aggressive financial engineering. So solid balance sheets, paying the right amount of tax, not aggressively accounting or doing receivables financing and things like this, but just controlling and running a high quality business. So if bad times come, again, they should be quite solid.
I'll chip in just on so because Nick mentioned both technology and healthcare and investing in those through the last year. And I think when a lot of people think about technology, they'll think about the FANGs. We've not held the FANGs, we don't hold the FANGs. And so I think one of these quality aspects in terms of why we might hold up in falling markets and perhaps not keep up in markets that are racing really hard is that if you look at the technology companies that we do hold, they tend to be more business to business rather than business to consumer companies. They tend to have a lot of recurring earnings, as Nick mentioned, a high proportion of recurring earnings. They sell products that people consciously are buying, as opposed to the person in a social media context being the product, even though they may not be aware that they are sometimes. So all of those things lead us to believe that those companies will do well through the cycle, and that they won't have perhaps some of the regulators, as we've seen in Australia with the media code around social media, that they won't have that kind of pushback from whether it's society or from the state in terms of regulation. And similarly with healthcare, something like 45% of the largest healthcare companies in the world are the big pharma companies. And they're obviously in the media a lot at the moment because of the COVID vaccine. But they're not companies, again, that we typically invest in. You'll see that we'll be invested a lot more in the healthcare area around diagnostics, because it's a very low proportion of the whole system cost, but it's absolutely critical to getting diagnosis right and treatment plans right, prevention right, and also other companies that help overall reduce the cost in the healthcare system through technology, like a Philips, for instance, because of their connected care and the way that their machines increasingly talk to each other, helps reduce system costs. Whereas a lot of the big pharma companies, unfortunately, the way they price their drugs actually puts upwards pressure on the cost of healthcare. And so there some slight sort of differences, I think, perhaps between the way that we think about technology and healthcare investment and what you'd commonly see.
Yeah, that's great. prompts me another question, because I was thinking about it. You mentioned Unilever as one of the companies you've invested in, which is a large company, one that most people will be familiar with. But a lot of the other companies you talked about, a few, but and not sort of household names. And then you sort of said the ones you're not investing in aren't sort of household names. So, do you have a particular focus on the sort of smaller companies by global scale? Obviously, a lot of these businesses are massive by Australian standards, but is that a focus, or is it just a matter of that's how it fits in with the philosophy of the metrics?
Historically, we have leaned towards perhaps in a global scale, small and mid-cap, rather than the real mega-cap companies. And that's for a few reasons. It's firstly, on the sustainability side, it's quite often hard for a very, very large company to have control of all the different arms in the business and what's going on. And at any point in time, there'll be one part of it heading off in probably not the right direction. Secondly is when you think of the market cap of companies, it's often easier for us to look at an ANSYS, which is a tech business in the US, or a Jack Henry in the US, which are around that $25 billion market cap, which now in that area is pretty small actually. And imagining them getting to $50, $75, $100 million is pretty easy. Seeing the $1 to $2 trillion businesses getting to $4 trillion is a little bit harder for us. Now, ultimately, if you look back the last few years, that really large mega cap has actually done quite well, especially in the US. Hopefully what we've shown is that you don't have to invest in any of that. You don't have to invest in big US tech. You don't have to invest in FANGs. You can invest in businesses sitting more that $5 to $25 billion range that often operate in their niche, leading their segment, and they might be competing against one of these big conglomerates where it's just not quite as important within that conglomerate, or that little part within that conglomerate doesn't really have complete control of its business. And by that I mean its budgeting and the ability to get capex. It might be they have to compete to get money to fund their R&D or something like that. And they're up against one of our businesses that we love, who are completely running their business just singly focused on that one thing. We find they do well.
Isn't it, of that? Arista Networks make network switches, which are incredibly boring for anyone that's not a techie, but they're absolutely critical to the way the whole of the internet runs and the whole cloud computing transformation that we're seeing runs. And you see them with their big competitor in Cisco and those types of companies that are a bit more diversified, perhaps not as focused, have had a lot of legacy technologies which they're having to try and pull forward as well and get them to modernize, whereas Arista is focused on the thing that it does, and it's brought in a new platform to help enable that, and so it leads the world in terms of its technology, and so that's the type of business that makes a lot of sense.
The other great thing is that you don't have to pick the winner often if you're picking these other companies, because it's these other companies that are often serving the whole range in a sector. And by that I mean we're invested in a Dutch electric vehicle charging station called Alphen. So they're rolling out electric vehicle charging stations throughout Europe. They're serving everyone from the big oil companies through to municipalities and governments, through to auto companies. We don't have to pick how those larger businesses are going to evolve into a more carbon constrained future and the opportunities there. We can go for the company that's supplying and in the lead supplying to all of those businesses instead. And so if you're in some of the slightly smaller businesses, you don't always have to pick that winner in the race to the top as well, which is quite nice. You mentioned before, not a big focus on the macro side of things, but so you can tell me you've got no opinion on this, that's okay. But how do you look at things like interest rates and currency when you're looking at a global fund? Yeah. How do you guys factor that in? So currency particularly, very much at the company level, bottom up. It's quite striking being an investor in India, for example, how much they love getting US dollar debt. We have been invested in a Brazilian consumer company in the past that also had a great deal of US dollar debt. So those debt imbalances versus a natural hedge are important to understand. Too much financial engineering around the interest rate side for a company in terms of are they able to borrow in one country and then invest in another to try and arbitrage the interest rates themselves. We see that happening as well. We much prefer companies just to focus on running their business. So at that bottom-up company level, we do look at currencies and interest rates. In terms of thinking about it at a global scale and how it fits with all our companies and putting together the portfolio, it's just not something that we do.
And a lot of our businesses are really leading, so it can be deceptive in terms of if you were to look at, and I know the presentation is going to be shared with this video, you'll see that there's the top 10 and there'll be a pie chart with what countries of exposure that we have, but even within those, they might be domiciled there and listed there, but they actually draw a lot of their revenues from exporters. So we have a number of businesses in the UK. I think every single one of them actually generates more in foreign currency export dollars than they do in pounds.
Yeah.
So when people talk about Brexit and the pound and those types of things, the businesses that we're invested in somewhat less impacted, I guess, in that respect, which as Nick says, you've got to really look at it from the bottom up, and where are they generating revenues, where are they getting the debt from, if they're using debt, and where are the costs coming from as well.
What do you see? Do you see any particular parts of the economy or any particular parts of companies or your portfolio that is sort of carrying the most risk at the moment, or areas you particularly avoid?
Yeah, so the area we're probably most concerned about is in highly indebted parts of the economy. We are intentionally ensuring that we are invested in companies with strong balance sheets. We're looking at liquidity and solvency. And that just reflects that moving off very, very low interest rates, even small amounts, are proportionally quite large when you're dealing with a great deal of debt. So we're particularly concerned about that. Obviously, we actively do not invest in companies that we see as doing harm in the economy, society, the world. And so we have never been invested in fossil fuel distributors or generators, for example. So industries like that, we would have a great deal of concern for, but it's an area that we just don't pay a great deal of attention to because of those reasons.
Are there any businesses in Australia that catching your eye doing things well?
Yeah.
Or
Yeah, I mean, Australia is a fascinating economy. I used to be in our Edinburgh office, and as we mentioned, we do emerging markets and Asian investing as well. And Australia has a striking similarities with both Nigeria and Brazil. You've got commodity currencies, you've got a fairly cozy oligopoly banking system, you've got strong resource sectors powering the place, and you've got slightly inefficient or uncompetitive sectors broadly in the economy. So we look at Australia and see a handful of phenomenal leading companies. Most of them are in healthcare. So, you know, the obvious is things like CSL, Cochlear, fantastic businesses. There's then one or two now in tech. So you've obviously got things like Atlassian and Xero, although Xero's probably like claiming Russell Crowe, I think, or Crowded House. Yeah. So there's very few on the global scale. Many others, the reality is they're not competing on the global scale. It's hard to, outside of those, it's hard to name Australian companies that compete and win globally. It really is. And so that's the small pool we're contained to. We are invested in CSL. We think it's a phenomenal business. It's shown that over decades, that they can compete on quality, they can be innovative in product development, they're providing an essential service in providing plasma to the world, or facilitating that, and they make great returns for shareholders. So it's a fantastic company for our fit. We're also invested in Cochlear, again, a leader in the technology, bringing hearing to those who desperately need it. Again, another fantastic business. But it's few and far between for us. We'll never really own more than 3 or 4 in Australia.
Okay. So for our clients to know, you know, those who are already invested in the AAN sustainable growth model will know that Stewart Investors is managing about 15% of that portfolio. So clearly the AAN investment committee has bought into the story, and the sustainability story resonated strongly with us. Where would you like to see, and given it is, as we talked about, an emerging sort of area, and there's a lot of talk about it at the moment, where would you like to see the sustainability investing go over the next little while?
Great question.
Yeah.
Do you want to?
Sure. Well, so I think Well, it's been interesting for us because we've been at this for 16 years or so. So 2005, as I mentioned, was the first sustainable fund, and it's become hugely popular. There's a lot of funds under management going into proliferation of new products, and we wonder at how high quality some of these products are, because we work very hard at trying to understand the sustainability of the businesses that we're investing in, and so often we kind of scratch our heads. There's been a game in the office where you can pick out the top 10, or you look at the top 10 shareholders of a really bad company, and then you'll see how many of them are running sustainable funds or signed up to different sustainability initiatives. And so for us, how do we kind of deal with that is by more transparency. And so we have got a microsite which will be linked to in the presentation, where you can look at every single company that we invest in across all of our different strategies. It provides a brief explanation of why we're invested in it, what we see the risks are. So we always try to provide a balanced view of because there is no perfect company. And then people can make up their own minds about whether our view and vision around sustainability is aligned with theirs, and be fully conscious of that decision when they're investing with us. And we're also always open to have the conversation with clients as well, which we have all of the time, where we have questions about it. And so I think for us that really works, because it isn't a perfect world, and we are trying to move from one place to another in terms of sustainability, and so there's a journey involved, and hopefully that our clients recognise that we're doing that as well as we possibly can.
Yeah, you'll also you'll see on our website that the team, all of us, write quite a lot around the topic and have done for many years. So there are topics that we've written about on our website where we take on issues around sustainable investing, around the investment industry generally, and write about everything from the role of stock markets and things like whether shorting should be allowed, is it useful for people, through to what type of healthcare companies make sense, for example. At the same time, we're trying to continually add rigour to our own assessment of our own approach to sustainable investing. And so there's a couple of things you'll see on the website again, where we are mapping our portfolio against some quite rigorous, frameworks. So one is called Project Drawdown, which is a fantastic framework looking at how different activities can draw down emissions from the atmosphere to help us get towards the Paris Climate Agreement targets. And then the second is a cut through the portfolio against the Human Development Index, which is trying to put a proper social framework against what we own and how there's contribution. So as Pablo said, transparency is the key for us. And, I think if you are going to stand up and say you're about sustainable investing, you need to show people, and you need to be able to provide them with evidence. So it'd be great if the industry just kept pushing that along, because without that, you open yourself up to finger pointing and accusation.
Yeah, and from a consumer viewpoint, the risk of greenwashing, I think, is the term that comes across.
Exactly.
And I think we probably, in putting the AAN Sustainable Growth Model together, came across a few different versions of what may or may not be appropriate and have different views, which I think you're always going to get.
Yes.
I heard that there was some recent legislation or directives in the EU around transparency and truth in labelling. Do you know much about that? I'm sure you're right across that.
Yeah, it's interesting. So we do have funds that are available, and because of the Edinburgh Heritage have quite a big presence in the UK. I think those types of standards come about because of the types of issues that Nick was talking about and I was talking about, where people need to have a high degree of confidence that if fund managers are making claims or pension funds are making claims, that they're actually fulfilling their promises. And I think to some degree that hasn't happened, and so that's why the reaction there. And then the other piece of that is that they're also very focused in the EU on trying to drive finance to really play its full role in contributing to sustainable development. There's a lot of challenges that require funding. So whether it's through thinking about the Sustainable Development Goals or thinking about reducing emissions, we're talking about trillions and trillions of dollars that need to go into new energy, electrifying the transport system. So Nick mentioned Alphen before, one of the companies that we're invested in. And so they're really looking to try and nudge financial markets to fund those appropriately. And so We haven't seen that as much in Australia, but you're seeing these types of sustainable finance frameworks come about. All sorts of places, Canada, New Zealand, China is leading the way in terms of these instruments called green bonds, which are bonds that specifically fund green activities. And so I think all around the world, you're really seeing regulators and the community at large just look at the finance sector and say, you've got a job to do here in order to help fix these problems. And so that's the driver that we're hoping will help reform the way we all think about our roles in society.
I like the sound of a couple of things you mentioned about the ability to measure impact or benchmark it. We're benchmark unaware in terms of the investments you're holding, but being able to measure the good that you're doing or the factors you're influencing, I think is growing in importance.
Yeah, and we do that because we genuinely see the investment benefit out of it. The whole philosophy is around saying these companies will earn the incremental higher cash flows because of that positioning and what they're doing. So, we're invested in Hoya in Japan and Alcon in Switzerland, which are both eye-lens businesses. One's the consumer lens business. There's still about 2.5 billion people out there with myopia who don't have access to that. Alcon's more focused on the surgical lens side through cataract surgery and the like. Again, growing and huge need, particularly in the emerging markets. And just a fantastic way to position your business. Something that's critical, needed, makes a huge difference to people's lives, rather than a fashion handbag business or a high-end alcohol business or whatever the other alternative may be. I mean, one thing we haven't touched on is we have about 50,000 companies out there we can pick from. We're only looking for 50. Yep. So we can be particularly picky. Yep. There's many different ways many different paths you can take and get a good outcome. We think if you pick these 50 high quality companies that understand the sustainable development needs and position their business really well for that, you can get great long-term growth and returns.
That's funny. I used to, when I worked in big companies, and the CEO would say, our people are our greatest asset, and you'd think, oh yeah, whatever. But it actually is true, because you look at the companies that have really engaged workforces, and they tend to be companies that have leaders that people trust and see that they're acting with integrity, they perform better. And it's been empirically shown, but also I think we all know it ourselves, that when we feel that sense of purpose and belonging, we'll work harder for no extra pay, but because we believe in what we're doing and we're wanting to do a better job. And so I think those types of things actually don't come through in the P&L directly, but we see them, we know that it happens, and so we spend a lot of time thinking about how are employees treated. Are they engaged? Are they bringing people through? Are they ensuring that there's diversity at senior management and board levels? We think that they're right because there's obviously a social justice issue there, but they're also really good for the companies over the long run if they operate in that way. And so that's really the bringing of the two together. That's how we're thinking about those issues.
And that's where the long-term relationships that you build allows you to keep an eye on that, assess that, and factor that into your thoughts about where you deploy your investments.
Yeah, exactly. And also those relationships are handy because in the public markets there are no perfect companies. Things always come up, often allegations, but there's media noise all the time about things that go wrong. And with that relationship, it can be handy to get on the phone or email a company and have a chat with them and just try and work out what's actually going on. Because every company out there at some point, something will go wrong somewhere. And their response to that and how they want to address it and what they learn and everything else is worth a lot. And building a relationship with time, I think, opens those doors a bit easier.
That's great. Is there anything that I should have asked you, or anything that you want to add before we sort of wrap up?
I think it's important investing in our product that you do recognise it's about long-term investing, not chasing the short-term trades of what the latest fad and trend is. There's no in and out of GameStop in this fund, for example. Yeah. We're genuinely looking for high-quality people with integrity and stewardship who run high-quality franchises that are in control of their destiny. They're not cutting corners. They're not financially engineering to juice the lemon as much as they're possibly can, but they're just running businesses the right way for good long-term outcomes for the environment and society, and that will, we think, provide fantastic returns.
I couldn't add anything to that, so we'll leave it there. I think that's a great way to finish.
Fantastic. All right. Well, thank you, Nick. Thank you, Pablo. I really appreciate your time. Thanks for all your work for our investors today. And keep up the good work.
Thank you.
Appreciate the invite. Thank you.
Okay. Thanks.